get ready. You know, we got the whole crew to put together, so
Move
I need
over.
to get going. But
Okay. Well, the
Canoa's
manager's
been
in
on
first place
fire,
right
man.
now. Yep,
Yeah.
yep.
So
Hello, this is Marco Cronin from Windermere Real Estate. Thank you for joining us for another episode of our Coffee Table Chat. Today I'm joined by Jacob Washburn of Cornerstone Home Lending, and we always try to give real life scenarios to help our clients out. And today I have, I think, an interesting challenge for you maybe. We're running into this with some clients, so I kind of want to run it by you if you don't mind.
Yeah.
So we have clients that have a house up in Green Lake right now. Great house, but they want to upsize to something a little bit larger. Their family's growing. And the challenge we have in the Seattle market right now is some sellers feel that if they sell their house now, which is kind of the easy part of things right now, to be honest, but then they're going to have a challenge buying, you know, and so some sellers feel they're going to be homeless. And so the scenario comes up is, how do I buy my new place before I sell the current one?
totally.
And, you know, because in this case, they don't have a huge down payment saved.
Yeah.
You know, they need the money out of the house.
Yeah.
So,
Yeah,
what do you think?
and we're running into that a ton right now. Just like you said, it's such a seller's market right now, and buyers are having a hard time getting into homes because of inventory. So when we see that scenario, there's really two challenges that we come up against. One, like you mentioned this case, either that buyer doesn't have the down payment for a new home yet. The other is, if they were to buy first, they may not qualify to carry two mortgages simultaneously. Okay. So I guess to attack that first one is if someone, they can qualify, but they need funds for the down payment. There's a handful of ways we can approach that. What we'll typically recommend is that they get a home equity line of credit on the home that they currently live in. Okay. That way they can access the equity from that home before having to sell it. Okay. And we can use those funds as a part of the down payment on the new home. Okay. And what a lot of times they'll do in that scenario is they'll make a smaller down payment to purchase the home, and then once their current home sells, they'll take the proceeds, pay down the loan amount in order to get better terms in the loan.
Oh, okay.
So whether perhaps they're paying mortgage insurance for a couple months, they can just pay that loan amount down. That mortgage insurance goes away, for example.
Great idea.
Yeah.
And then if they pay a big lump sum from the house they're selling on the new house, can they recalculate what their payment is going to be?
Yeah. Okay. There's a couple options. A is obviously you can always refinance, but if rates don't make sense, you don't want to do that. Right. So a more cost-effective way would be to conduct what's called a payment recast. Okay. So you'll take the proceeds from sale, apply those to your new mortgage, and you'll recast the payment based on that lower balance. So that way that person now, over the long term, they're having a lower monthly payment because they've applied those proceeds. Okay. Yeah.
That's an awesome scenario. Okay, what else you got?
And the other thing, like I was mentioning, is sometimes people, they may even have the cash for the down payment, but they don't have the ability to qualify carrying two mortgages. Okay. Now what's happened just the beginning of 2016, Fannie Mae has come out with a new rule that on the home that you're departing, as long as you have a lease agreement in place, we can verify that first month, last month, deposits have all been made, we can actually use that lease agreement and use that rental income to offset the mortgage payment on the home that you're leaving. So basically, if you have a lease agreement in place, that lease agreement can cover the cost of your current mortgage, so then you're only having to qualify for the new mortgage. Yeah.
And that's a great option for people that maybe want to grow their real estate portfolio as opposed to selling and buying. So that's an interesting idea.
Absolutely. And that's me personally, my wife and I, that's how we got started. The first house that we purchased was the home we lived in. We lived there for about 3 years, and we moved out of that, kept that current home as our rental property, and that's really been a benefit for us financially as far as our long-term real estate goals.
Okay. Very good. Well, I appreciate the info. So we have either the option of doing a home equity line of credit on the current home, using that for down payments on the new home, or you can, if you want to keep the house, count the rental income as long as you have a lease, and then qualify for the new purchase. Perfect. Because it's not. It used to be in a down market, or what's called a buyer's market. You could purchase contingent upon the home selling, but as you know,
today
we can't do that now. Any contingent offer is pretty much pushed aside because you have 6 or 7 other offers waiting. Okay. Great. Well, if you have any other questions on options on how you can sell your current home after you purchase your new one so that you're not homeless, give me a call, or you can also go to my website and email me, urbanmarco.com, or give Jacob a call at Cornerstone. Thanks for watching.